All right, everybody. Welcome to Zach's Corner. We're in September of 2021's edition of Logistics Managers Index, and it is posted at the first of the following month, right? This is October. So be sure to go to the Logistics Manager Index for the updates forthcoming. Today, joining me is Zach's Corner. Wouldn't be Zach's Corner without Zach Rogers, Assistant Professor of Supply Chain Management at Colorado State University, where supply chain management is the new MBA. Rumor, but anyway, good stuff. Myself, John Graham, BM2 Freight, here hosting Zach's Corner today on behalf of Rocky Mountain CSCMP Roundtable, as well as support from BM2 Freight Services. For those who are joining or in the past, right, Logistics Management Index is the focus of our content today. Just getting kind of since we're in Colorado, right, the 14,000 foot view, overview, and take this information back to your decision making and planning as we hypothesize what the transportation, supply chain, logistics market changes are happening. This is a great barometer for that. Highly encouraged to continue to use it as a resource. And I love the business model. It's free for all of us.
Great. Well, thanks, John, for the intro. I appreciate it. And you're right. That Bloomberg article, supply chain is the hot new MBA for the pandemic, and you can see why when we start to go through some of this stuff. You can see how busy and crazy supply chains are. I'm sure people watching this know it, but sometimes it's good to separate the things that you're feeling, the things that you're seeing, to again that 14,000 foot view. What's going on in the macro economy? So to remind everybody what the LMI is, the LMI Logistics Managers Index is a change index where we send out this survey here. It's quick. We basically ask these questions you see on the screen about 8 different metrics: inventory levels and costs, and then for warehousing and transportation, capacity, utilization, and price. And so we ask people who are director level and above, so they have that 14,000 foot view. What are you seeing? What are you seeing in your companies? And I think we've done about 5,700 responses now since September 2016. This is kind of a special one, actually, because this is our 5-year anniversary. So this is a big LMI report for us here at LMI headquarters upstairs in my house. It's interesting because you can see we've now been in the 70s for a pretty long time. So 72.2 this month, and really everything over 70 we would classify as significant rates of growth. So really high rates of growth. It's at this point we're 2-3 standard deviations above 50, because 50 means kind of everything's even, and we're all the way up at 72. And in the past, for the past year, one of my favorite little things to say is like, well, look at where we were a year ago, in COVID when it was in the 50s or 60s, and I can't do that anymore because last September it was 71 essentially 70 and a half. And that's kind of the problem. The problem is that we've been so high for so long. And if you look at the last 9 months, okay, January to September, the highest 9-month average we've ever had. And that's the first 3 quarters, of the year. And for those of you out there who paid attention in school, you remember, hey, there's another quarter coming, and that tends to be the really busy one. And so it's going to be interesting to see what happens as we get in the fourth quarter. And just to give you an idea of really how unusual this is, because normally the graphs we show, we kind of do 2-year moving graphs, but essentially it's the 5th anniversary. I thought I'd put this together. Here's all 5 years of the LMI. Okay, so this is just the overall score, not all the separate metrics here. And again, 50 means break even. And you can see actually we've never gone below 50 even one time. The closest we got was in April of 2020. We got down to a 51.3, and you remember April of 2020. We're staying inside and watching the Michael Jordan documentary, and just not really doing nothing was moving anywhere, right?
But look how fast the recovery was. It's crazy.
Yeah.
It just obviously from the events of 18, which was the last time we really got kind of out of out of balance in at least in the transportation marketplace, where obviously a 75.7, but look how long that tail was.
Exactly. No, that's exactly what I was about to say. Is, so we hit that 75, and it's funny. You can see where it pops up, right? January 2018. Here's the tax cut happening right here, and so we had that spike. And it's interesting, by the way, and that's a great point, John. It's interesting to see how quick the spike was, and then we kind of went back down. We didn't have this sort of year-long high level of growth. We sort of had a really quick level of growth that we thought. Remember, I'm sure the transportation people in the audience remember, we thought that was going to go for a while, had some overinvestment, and then we had that long dip. So basically from, by the time we got to fall of 2018, all the way through COVID, we had that sort of dip. And, we had something like 2,000 small carriers close around that time.
A lot of bankruptcies.
Exactly.
A lot of
and
some big
left
carriers
right.
too.
I remember there was an article in, I think it was in January of 2020, that said essentially we have too many trucks. I remember it being in the Wall Street Journal. Too many trucks, too many assets, too much capital equipment. We don't know what to do with all these trucks. Oh, for the days of January 2020 when we had too many trucks. Because then you can see we hit this 51, and it's almost like going straight up a mountain. This, in many ways, actually, this looks like a mountain range in Colorado in some ways, with the jagged spikes. And now we're up here, and we've been essentially in the 70s territory for about a year. The only 2 months where we actually dipped below the 70s were December 2020, January 2021. And that was really a function of we burned off a lot of inventory. We move a lot of inventory at the end of mid-December. And so they were low, but costs never really dipped. And, you would expect, if you kind of think about the way supply chains work, you sort of build to a crescendo in fall, in the end of the year, and then you can kind of reset in February and in January, right? We kind of, okay, let's reset. And there's sort of a cyclical thing.
Well, and
we didn't really have
there's seasonality too, right? Where you can almost follow produce, on a map, counterclockwise, throughout seasons. Well, in January, February, like you said, the available tonnage typically is not there, but history is we're making history as we go.
Exactly.
And from Edge last week, as talking to buyers of multiple millions and billions of transportation, asking what their bold predictions are, and they're basically saying we can't overlook what's happening today to understand what's going to happen in Q1 of 22, right?
Yeah.
Sure, we're optimistic, we can make some changes, but we're having to really, make quick, agile changes to our networks to just function today, which says a lot, right?
The point is, it's unlikely we're going to see that reset happen this January and February. We're so deep in the hole, and we saw this last year, right? We didn't really have a reset time. We're going to have to keep digging out and digging out and digging out. And by the time we're sort of getting caught up, we're already going to be back to peak season again. And so I would expect us to see, and we'll get to the future respondents in a minute, and they echo this sentiment. Really, I'm echoing them. I would expect to see these high costs and tight capacities continue at least through the next 12 months and maybe into 2023, I would assume.
Yeah, in your the latest LMI, you referenced some big logo customers. I think there was Home Depot, Coca-Cola, IKEA, where they're making pretty strategic moves now by not saying, hey, we're going to put a lot of boxes on a ship. We're actually going to buy the ship and all the containers on it. Exactly.
Well, the shipping delays have gotten so long, some 85 days, some of them at this point, just crazy numbers. And so because of that, companies are just sort of, okay, fine. You know what? Instead of waiting, we just won't book. We just won't book our onto someone else's ship. We'll just do our own thing, so we don't have to wait. And let me show you this. We'll see some of this in a minute. But I want to show you this here as well. Here, I'll throw this up. There's an email I get every day from the Port of Los Angeles. The volumes coming through, and we'll talk about the volumes in a minute. But this is the number I think is interesting. Look at this. Current anchorage time, 10.8 days. Okay, so that's not in the dock. That's just at anchor, sitting there waiting to get into the dock. It's 10.8 days. And that's a 30-day rolling average. And what that tells you is that really for the last week, it's probably closer to 12 or 15 days. I remember there was a article in the Wall Street Journal in January. They do the logistics, number of the day stuff. And in January, it said, the average ship is at anchor 4.99 days. This is double where we were for the first 6 months of 2020.
Or potentially triple at this point.
Yeah, and we thought, oh man, 5 days, how crazy. And now it's 11. And so things have gotten totally off track. And it's funny, so yeah, as Costco, IKEA, Walmart, they all booked their own, big ships. Coca-Cola did the same thing, but they actually, I don't even think they couldn't even find a container ship. They have a bulk ship that you use for coal and stuff. And so it's pretty interesting, the creative ways people are coming up with to deal with this. And I want to point out one more thing on this slide. You'll see, okay, it does look like, all right, the LMI curve, it's going, it's all growth, okay? Anything above the black line means we're growing from last month. It's just, this is all rate of change, okay? Rate of change. So we're growing just slightly slower. That's actually in some ways a mirage that we've dipped a little bit. And the way that it's a mirage is that inventories are very low right now. Our inventory number was only a 58 in terms of inventory levels. And that's a function of, one, consumers are still buying things like crazy. And two, it's really hard to replenish inventory because of the slowness we just talked about. If we took inventory out of it and just looked at something like aggregate costs, our aggregate cost chart like we have here, you can actually see that aggregate costs up at 268.3. This is the all-time highest level of supply chain cost growth that we've measured in the 5 years we've been doing this. So when we put together transportation, warehousing, and inventory costs, okay, that's how we get on a scale to 300. Every one of those is 100, so just add them up. We're at a 268.3. Anything above 250 is really, really fast, significant growth, right? That's the equivalent of being at a 75 in the overall LMI. So to be at 268, that's close to being at like a 90 for all of the costs together. And we've been above 250 for every month since March. And I don't think we'd ever even been at 250 before March. And now we've been at 250 every time since then. And so the aggregate costs are growing really quickly. So it's not like, there's a ton of focus on the docks, and for good reason. And we're going to have a slide looking at the docks in a minute, because it's big. It's easy to see. Oh, hey, look, there's 70 ships out there. That's pretty easy for everyone to see. But that's only a small part of the story. It's also the warehouses. Long Beach opened up 24/7, and no one's really using the port 24/7. Because even if you get through the port, it's like, well, there's no chassis available. Right. And the reason there's no chassis available is because there's no warehouse space available. And there's no warehouse space available because there's no rail cars or trucks. And so even if we rush through the ports, 24 hours, okay, run extra crews to get through the ports, that's like speeding through a red light to get to 5 more red lights. It doesn't really make that much of a difference if we get through it, because capacity is low everywhere, which is causing high costs. And where that's really pronounced, by the way, we always break our metrics down, upstream and downstream, okay? So downstream would be customer-facing respondents, so retailers, stuff like that. Upstream would be further up the chain, shippers, maybe wholesalers, 3PLs, things like that. When I run the numbers, you can see we have some significant differences on 2 metrics. First one's transportation capacity. Now, transportation capacity shrunk in September for everybody. 41 is a significant rate of contraction. But transportation for downstream firms was 30.2, which is a crazy level of contraction. We're running out of space really quickly for downstream stuff. And that's specifically what we're talking about here, is getting inventory from the docks to distribution centers, and then getting things from distribution centers to stores, or from fulfillment centers to customers. We have a really hard time getting things on shelves right now because of the upstream crunch in capacity. And that's reflected in prices. Again, 89.7 for upstream firms, that's nothing to sneeze at, but a 96.6 for downstream firms, would be the highest metric we've ever recorded in any of our numbers across any single metric. A 96.6, the highest we ever had. And so if you're a downstream retailer who feels like, man, freight is expensive right now, you're not the only one, actually. If you're a freight broker and a lot of your customers are downstream retailers, you might think, man, Christmas, I know we're not going to have any presents this year, but Christmas feels like it came early for us.
Or be strategic on what you buy, because it's going to be inflated just a hair.
Yeah, I know. Everybody's trying to figure out, oh, it's inflation. Yeah, it's maybe interest rates are part of it, but really it's because the trucks are expensive. That's where it's really coming from.
Well, and think about, right, your warehouse, right? So if inventory is moving so fast, it makes you scratch your head. It's like, okay, why are we running out of warehouse space, right? Why? And is it, what kind of inventory is turning at a rapid pace versus what is forecasted to sell,
right.
Or, you know what I mean? There's such a combination of things, and with planning right now, because there's such long lead times, we've talked about this before, where we've seen an adoption of getting away from just-in-time supply chains, because it may not work, right? Because you're not getting your materials in time or able to commit to your end customer in time. And we're seeing more of the stockpiling to avoid, right, with the typical stock out situation. Is that kind of what your kind of feeling is with inventory and warehousing?
Yeah, so what's
as a
really what's
relationship?
happening is it's velocity. So
Okay.
inventories aren't building up because you can't keep them. Like inventories are moving. So, Best Buy had this idea, oh, we're going to build up all the inventories we need all the way through Christmas. That was the Best Buy plan. And I don't know that that's actually working. Because what we're seeing, if you look at total inventories, like Federal Reserve puts out total inventories, they're actually up from the same time last year. But inventory to sales ratio is up by like 60% from where it was at the same time last year. And it's because, okay, inventory is up 5%. That's great. That's the bottom of that fraction, inventory over sales. But sales, right? Or sorry, inventory is top of the fraction. Sales are up 50%. And so sales, because they're so high, really what we're seeing is our inventory levels are at 58 on the LMI. Our inventory costs are at 89. Normally those two numbers go together, but they're split right now. And what that tells us is we have a really high volume of inventory moving through at a really high rate of velocity. So there's a lot of inventory in the system. It's just moving out of stores. As soon as the stores have it, as soon as retailers have it, it's gone.
Right.
And we're not replenishing it from the supply chain too quickly.
Which historically, if it's getting sold super fast, that's a great problem to have. However, if it's not on the shelf, you can't sell it, right? So, and again, supply chain can't catch up with demand.
Right.
So
yeah, it's going out faster than it's coming in.
Yeah. Well, it's out on a boat somewhere, right? Someone said.
Exactly. And here's a picture of. That's a great transition, John. Here's a picture, by the way, of everything coming in. You can see we're going to be at 150,000 or so TEUs. The only reason, by the way, that this week is down as much as it is, and 88,000 TEUs isn't actually low. It just seems low in the context we're in now, is just because this is really them trying to clear the backlog and them slowing down how fast ships can come in so they can clear the dock, because at this point there's no space in the dock for ships. So they have to have these slow weeks in here so they can, okay, hold on, let us clear all this out, and then something new comes in. This is a picture, by the way.
I mean, historically too, right? I mean, we're just starting Q4, so historically we usually see kind of an exhale, right? For a few weeks, to kick off Q4, before things really start to really pick up again, right? So
yeah, I mean, at the docks, that's not necessarily always true, because the docks, you got to get it in. On the land transportation side, you do. That's true. But on the dock side, a lot of times, October, September, this is Christmas to them. This is when everything's coming in. It's like how I used to be a returns manager before I went back to school, and Christmas for me was like January 5th, because that's when everybody sent back the shoes they didn't like. This is a picture, by the way, of the San Pedro Bay from earlier this week, aerial shot. And if you pause the later on, you and whoever you're watching this with, I assume most people are watching this at night with their wife and kids, wind down
Yeah,
after dinner.
this
So
this
go ahead
great
and pause it.
dinner
Have the kids count
conversation.
how many ships are out there. When I did, it was about 55. Is what I saw from this angle, and we know there's actually more behind it. And again, it's not just the docks that are slow, right? So we have slowness all the way back. So factories in Asia, Nike today or this weekend told their shareholders, hey, we missed 10 weeks of production in Vietnam this fall because of factories shutting down, and then also docks closing and stuff. So we have slowness on the production side in Asia, both at factories and at the docks, and then we have slowness in the ports, and then we have, again, dock chassis aren't available, which is such a and by the way, I can't tell you how much I love it that there's now mainstream news articles about dock chassis. I didn't think anyone was ever going to care about this outside of me and my nerdy supply chain friends, and now it's like on the front page and stuff.
It just comes along with the territory, right? We
Yeah.
were having, capacity issues. Chassis is going to be brought up, right?
Mhm.
There's only so many.
Right.
I mean,
Yeah. And so then there's no storage after it. By the way, storage, I should point out, one of the reasons that aggregate costs are higher than they've ever been for us, warehousing metric, the warehousing price at 89.3, by far the highest it's ever been. And the fourth month in a row that we've hit a new high for warehousing costs, which normally warehousing doesn't act like that. Warehousing, because they tend to be long-term contracts, warehousing prices are much better behaved than transportation prices. I mean, transportation's the Wild West sometimes. I mean, that's up, it's down, it's all over the place. Transportation is kind of the wild child in the LMI, and warehouses are kind of normally, the goody goody. And honestly, I don't know if transportation's been a bad influence or what, but warehousing prices are acting like transportation right now and just going up all over the place.
well, I think as companies are being agile and having to flex and find other options, right? It's really causing, a new kind of, style of warehousing, right? Where they're trying to get away from long term because we hope it's not long term. We don't want to enter in a lease agreement
Right.
for 3 or 4 years and be stuck with a high bill once our longer term plan starts to go to back to fruition. So a couple of my contacts in the warehouse management space, right? It's a fire hose of requests because they're looking for that type of model. Well, even they're getting tapped out, and again, just like any other supply and demand driven marketplace, right? It's driving the cost up. So a good place to be in if you have available space, but even then, right? I think we were talking with a colleague of mine on the roundtable where he manages some space facility in Chicago where someone just basically tried to bum rush him and showed up with a couple containers. Was like, hey, we'll figure it out later. He's like, no, you don't understand. We've already committed to these other customers. There's not 1 inch of space I can help you out with. So coming to extremes for folks, I wouldn't probably recommend that. It sounds expensive for demerge and get that chassis and that box back into rotation, please.
No, it's
But if
I
you
mean,
got nowhere to put it,
if you're someone who has if you have capacity right now, if you have trucks, you have warehouses, you're like the guy on the first night of The Bachelor. You're like, I know there's some good ones in here somewhere, but I also know there's some not good ones, and you got to be really discerning, and make sure, like you said, we're going with sustainable contracts. We're going with stuff where it actually makes sense long run. And maybe there's a little bit of squeezing out extra props on top. Maersk, it's hilarious when you look at pictures like this, all these boats in the water, and then remember last month Maersk advised their earnings up by $5 billion. And so they're essentially they're, which people were so mad about, their customers, because it's like, wait a minute, you're charging us 10 times more for container, and delivery is 30 days slower, but you just made an extra $5 billion. What exactly happened here?
well, on the other side, if you're not making money, you're like, who are we partnering with?
I know.
This is probably the best market they've ever seen. If they can't turn a profit, like, whoa, maybe we should rethink this, right? So, I mean, obviously there's a balance there, and there are obviously stakeholders, stockholders. These are for-profit businesses, So, at some level, right? But I think we all agree that, good partnerships obviously share the ups and the downs in any market. So,
Exactly.
um, maybe
Well, someone should let Maersk
maybe
know
not
about
stop
that.
the process, but we're human at some level.
Exactly. So there is now some light. I think it's a dark light. It's far away, but at the end of the tunnel. So the last thing we ask people when they take the survey is, hey, where do you see this going in 12 months? And what's nice is that both warehousing and transportation capacity predictions are positive for the next 12 months. And that's the first time they've both been positive in a long time. It was either one of the two of them have been negative, but they're both positive now. Now these are very these are very moderate rates of growth. 52, 54. That's some growth. But you know what it isn't? It's not contraction. And that's important because it's been contracting, like we saw a minute ago, for essentially a year and a half. Now, even with both of these coming on with some level of growth, we're still looking at high prices through at least the next 12 months, upper 80s for inventory, warehousing, and transportation. And like it says there on the slide, there's a light at the end of the tunnel, but I think it's a pretty long tunnel. and we might be a ways away from getting all the way through it and getting to the point where we do have a lot of capacity. That being said,
I read something earlier this week where someone figured out, I wish I could call them out now because it's brilliant, how many drivers we needed in the marketplace to see that balance actually happen. The number was 25,000, which that seems like a lot of labor to enter the marketplace. But it sounds like, with all the metrics used, I'm sure there's enough trucks and obviously there's enough freight out there to keep everybody busy. But to see 25,000 people in a marketplace, that's a pretty long runway.
Well, that's why they're talking about crazy stuff like, hey, should we let 18-year-olds, drive Class 8 trucks? And, when I was 18, I could barely handle four wheels, much less 18. So maybe now, and, but we have, I think we need to make it easier, I think, for truckers to sort of exist. I think more sort of short relay routes, you're going to get more people in. And it's funny because the technology in trucking has pushed away, I think, some people because it's not, you don't necessarily have the freedom of the open road stuff anymore when there's literally cameras that are like, hey, did you look down at your phone? I'm sending your supervisor a note that says you're unsafe driving. And you're like, I'm just checking my map or whatever.
Right.
At the same time, I do think the technology has opened it up for more people. We're seeing a big push towards, it's funny at CSCMP, they're like, oh, big push for women truck drivers. And I was like, what is this, the 10th year in a row someone has said that? So I don't know necessarily where we're gonna build the labor in because I mean, the wages have gotten up really high. I mean, you can now
and what
come
we're
in
seeing
at
too, right, is carriers, drivers are going out on their own. So we're starting to see that kind of, that shift, right? You talk about your upward, downward trend of, carriers entering the marketplace, but not
Yep.
necessarily equipment or drivers, just companies, right? So they're breaking off from, maybe a larger carrier and going out on their own and, either their own equipment, leased, whatever it is. And we're starting to see that 1 to 5, carrier mix starting to trend up, which was already a large segment of the overall for over the road carrier for hire marketplace, right? So
yeah, but
um,
like we said in the beginning, I think we lost between 2 and 3,000 small carriers in that sort of the slowdown we had in 2018, 19, and the beginning of 20.
19 for
And so
sure.
that burned out a lot of that small, regional carrier sort of market. And there's a little vacuum there.
Or just people running the boards, right? Going, relying on 3PLs, postings and things like that to, keep their wheels turning,
Yeah.
right? Be that
And
sales
so I,
arm.
I think people are rushing into that vacuum. And yeah, you're right. People are just running the thing. So the last thing I guess I should tell everybody, because I think we're right at about a half hour.
Yes, sir.
New LMI reports come out the first Tuesday every month. And you can see new reports or any old ones at www.thelmi.com. You can even see the old bad reports that don't look very good from like 2016 and 17, but they're up there. And if you got a question about the LMI or you'd like to join the survey board or talk to us about it, feel free to send me a note. And there's my email address right there. We're always happy to get more people looking at the survey and thinking about it. You know, the more sort of voices we have in here, the more accurate the number gets. So we always appreciate, you know, more respondents, and we're not one of those companies that'll bombard you with a million emails. We'll send you say, hey, can you take the survey maybe twice in a month? We'll send you the results when they're done. And again, we won't charge you anything or sell your data to any weird marketing companies or something. Again, it's really a bad business model for us is what we have.
Oh, good shout out. And thanks, Zach, for going over the LMI highlights for September as we look forward to the next one. Thanks, everybody, and have a great rest of your day, week, and year.